Imagine spending an hour with the world's greatest traders. Imagine learning from their experiences, their successes, and their failures. Imagine no more. Welcome to Top Traders Unplugged, the place where you can learn from the best hedge fund managers in the world so you can take your manager, due diligence, or investment career to the next level. Before we begin today's conversation, remember to keep two things in mind. All the discussion we'll have about investment performance is about the past, and past performance does not guarantee or even infer anything about future performance. Also understand that there's a significant risk of financial loss with all investment strategies, and you need to request and understand the specific risks from the investment manager about their product before you make investment decisions. Here's your host, veteran hedge fund manager Niels Kostrup Larsen.
So I'm saying in the VIX, very easy. I would say even in equities and fixed income, you have the same thing going on. If you buy the S&P when the realized vol is low, you typically lose money. When you buy when the realized vol is high, you typically make money. And effectively, you can use volatility only as a way to time the S&P or equity indices, just because of the way people are trading it and the way people are sizing their positions. You can trade against it, which is what all those mean reversion models that you see today are. Right.
I think I agree with you. Yeah. Meaning just making sure that I fully understand. But it's true, and I think it's true as well in the trend following space that those firms who really find something unique to do, they could be called a trend follower. But if they do something unique, and we see that there are a few of them that have delivered good returns, even though. As I noticed, the B-Top 50 index, which is the biggest, 20 biggest firms in the industry, since 1990, there's been 7 negative years. 6 of them has come since 2009. So you're right. I mean, so the majority doesn't seem to be adapting well, but there are people who truly find unique ways of dealing with this. And in a sense, I feel that investors are unfortunately going for the classical cheap solution, not knowing that they're leaving all the returns for others just because they charge a little bit more, and that's really unfortunate for the end investor.
Sure. Retail always loses. I don't think CTAs are going to break that rule. So the more convincing in a certain period an investment is, the more likely you're going to lose money. So this is why sophisticated investors at a certain level are able to stay ahead of the market and allocate when a strategy is losing, as opposed to try to chase returns. Chasing returns, which feels amazing, you can have anybody do it, typically is counterproductive. So a lot of our brain is designed to chase returns, like on a strategy level or an investment or Bitcoin or whatever. So the upside of a bubble, it's easy to convince people to come in, right? So there's a delicate balance where this is where you have to know yourself and know where you're coming from, and realize that the scientific approach in investment is not the same as a scientific approach in an external process, which is independent. Investing is a very complex process where your perception of a market affects future returns. And your perception, because our brains think contagiously, so it means if I'm thinking something, if I feel something, everybody in this room is a little bit feeling the same thing. Especially in the investment world, it's very contagious. People all believe the same thing at the same time, and there's major cycles that happen. To be able to isolate yourself. So first, having all the techniques in place that you're evaluating the scientific aspect of an investment, the way that consultants do, that's not enough. Then you have to go further and have a certain courage to invest where nobody else wants to allocate at that point in time. And that requires a certain aspect of self-knowledge. This is the requirements to be successful in CTA investments are not the same as other aspects of life. So it requires a certain personality characteristics, which are not, I would say, not common. Yeah. People have to take those into account when they're allocating to smart beta. Otherwise, it's going to become the same losing game over and over. You can use what investors think to, as a contrarian indicator.
Mm. Yeah. What about?
Let me add one thing.
Yeah, okay.
Smart beta, I would say, or the longer term indices haven't done well. Also because the opportunity set, it's been a very, very extreme macro environment. Right. Central banks have about 20 trillion in assets globally that they've bought, they continue to buy in the last couple of years. So the lower the vol, the bigger the impact of crowding. So when the vol expands, the stocks become more spread out, and then effectively there's much more liquidity available for the typical trend following models. I don't see the fact that CTAs have had 6 years out of 7 negative in the last few years as a negative. If you take convexity into account, again, you're long an option, you're still getting it cheaper with long-term CTAs than you're getting it, buying it directly in equities, for example.
Yeah,
so it's still valuable.
Yeah, I want to stay on a topic that, I think 2017 probably was the year where, to many investors, VIX really became known, right? Everybody suddenly talked about the VIX, right? And it's been a little bit under the radar beforehand. And so what's your opinion? What is the impact of the growth of VIX sort of volatility trading in sort of the, in our industry, but maybe also outside the industry?
Sure. So certain investments that don't have great risk-adjusted returns can temporarily turn into amazing bubbles because the return stream has certain characteristics which gives time for other investors to come in. So it becomes very self-reinforcing, like a positive feedback loop. And there's ways where in certain industries you can reinforce that intentionally. If you're an activist investor, you put on a position and then you say, here, I got my position, other people come in, you can do great. You're effectively, it's like a pump and dump of penny stocks in the 80s, right? So cryptocurrencies are a little bit the same thing. They're being promoted. I mean, I'm receiving text messages here and there saying, buy this, only this much for each account, whatever. So effectively, these things are being a little bit manipulated. And in the same way, regulators, in a way, if they don't control these things, it can be very, very harmful for investors in the long term. So in the case of the VIX, starting from the Fed put, starting 2009, which was basically the market is not going to go down 50% anymore. It's only going to go down 20%. Then you had the equity hedge funds, which had always said, since it's going to go down 20 only, I'm going to buy it at minus 15. Then because the minus 15 is there, then you had short-term swing traders who bought it at minus 10. Then you had short-term CTAs who bought it at minus 5. Then you had artificial intelligence or machine learning techniques which said buy it at minus 3. So it's become a very self-reinforcing where effectively people are now justifying that the economy is doing great and that's why the vol is low. There's an aspect of the reality is markets lead the economy and not the other way around. And I would say today what's going on in the equity world and the VIX in particular has become a very self-reinforcing bubble, which is suppressing the vol in the market. So when the VIX or when an implied vol in a market comes down, when people sell options on a market, until those options expire, effectively you have mean reversion trading. If the market goes down, the option sellers are buyers of that market as it's going down, and the option sellers are sellers of the market when it goes up, so they suppress the vol of the market. Typically, that lasts until the options expire. So look at the open interest in a market. Where was this? What drove the implied vol compression? Options of this maturity. That's typically when you're going to see the mean reversion out of the market. Then it typically breaks out. Okay, yeah. So the VIX is quite a serious thing because a lot of I'm going to say very sophisticated investors are putting large amounts of money at play in it, and based on volatility. Normalized risk techniques, they think they're taking very little risk.
On that note, Nigol, I think that we talk about, you mentioned the word manipulation. There's the VIX. You talk about big trades and so on and so forth. but I think there was an article in Bloomberg recently that mentions that on December 20th last year, 2017, the quote-unquote VIX elephant put on a very large position, something like 260,000 lots. And the article went on to talk about how relatively easy it is to manipulate the settlement, which has a huge impact if you're trading options and you're waiting for expiry, et cetera, et cetera. I mean, do you have any thoughts about this? And because one of the things that our industry has always been known for is liquidity. We're not manipulating markets. We're not creating trends. We're not doing anything like this. The VIX seems a little bit out of the ordinary when it comes to this.
The VIX, by the way, in 2017, there was a 6-month period with a Sharpe ratio, and it was 15. On the Euro VIX, it was 30. Right. Yes, it's a little bit out of the norm. Right. I would say like 100 times over. Yeah. But yes, so with volatility, the amount of risk or the amount of gamma that you have in the market is highly variable over time as you approach expiration. So you come in and you say my vol is this and my delta to the market is that, and then as you approach expiration, your gamma or the level of mean reversion that you're willing to do or the amount of liquidity you're effectively providing to the market increases exponentially. So I would say in particular, it's easy to manipulate the VIX. And today in an industry where I would say there's potentially some misalignment of interest between the interest of hedge fund managers where they participate in the upside but not the downside towards year end, there could be quite strong incentives to make sure that the market stays where it needs to be for a good payout year end. So effectively, if consciously we're talking about risk being volatility based, and I say my position is this, I have a 10% vol and I'm going to short 10%, I'm going to keep a 10% vol and short the VIX, you're going to create this bubble very, very easily in the VIX. You don't need to do this on the VIX. If you look at equities, you look at fixed income, over time, or the all-weather portfolio or risk parity, where positions are inversely sized to, let's say, 1 year, 3 year, 5 year vol, the fact that people are allocating, let's say, to equities and the vol is coming down, they're constantly increasing their leverage and they're reinforcing that cycle. The same way, the leverage today in a 10 vol risk parity product is 6-1, where at a peak in 2007 it was 4-1. In 2003, it was about 4-1 as well. Today, just the fact that people are chasing or saying, we agree, I'm going to put on 10% vol. You don't complain, it's stated. Now I go do this. And in the market, if I do it in a way where I'm timing my entries correctly, I can basically suck in a lot of quantitative traders in the process. So I'm saying in the VIX, very easy. I would say even in equities and fixed income, you have the same thing going on. If you buy the S&P when the realized vol is low, you typically lose money. When you buy when the realized vol is high, you typically make money. And effectively, you can use volatility only as a way to time the S&P or equity indices, just because of the way people are trading it and the way people are sizing their positions.
Do you trade the VIX?
We put on tiny positions for, as I said, mainly for entertainment. So we look at we can extract convexity out of the market by trading delta 1 futures. We don't need the VIX to get that. And if we want the negative skew, we can generate negative skew by trading delta 1 as well. So models that bottom pick the S&P have Sharpe ratios of 4 and 5 in the last 3 years. Again, we provide those for free. So you can get that convexity without trading the VIX. But we trade it out of, how can I say, almost with a smile. Yeah.
So one of the things that so we started out the conversation today talking about 2017, difficult year, learned a lot, lots of meditation, all of that stuff. I'm assuming that you adopted or evolved or innovated during the period to essentially overcome this low vol or the compression of volatility that's. Can you talk a little bit about what and so how do you change a model like that without losing what your original profile and what you're known for to be able to actually make good money in a period where the S&P is still going up?
Yeah, that's the $1 million question.
Yes.
Okay.
So I'm glad we get that in now.
So obviously, you want to adapt. Did you learn anything? An investor tells you, says, no, we questioned ourselves substantially. We continue to believe that we're aiming our strategy for a slightly higher level of vol. So we adapted, but not by taking away our positive convexity. The way we adapted is by seeing what type of noise is actually happening in the market. And so instead of trading certain time frames, we diversified our time frames where the typical noise. So suppose you're running a 300-day moving average, and if the market goes up for 30 days and comes down for 30 days, you're exactly on the opposite cycle. Yeah. By diversifying the time frames that you're trading short term, going more intraday and slightly longer term rather than a more focused daily frequencies, you're able to evolve, be less vulnerable to a type of noise which is in one frequency, which is what happened in 2017. So first we diversified the frequencies that we're trading in the short term. So instead of like 3 days per trade, we're trading, 6 hours, 12 hours, 30, that type of thing. One. Second is we added a mean reversion component. So instead of being 100% long momentum, we're trading 130 long, 30% short. So without getting effectively, we're saying we want to provide liquidity in the market at certain times in order to hide our footprint. Mm-hmm. So, as I mentioned, you can be momentum mean reversion neutral and provide liquidity at the same time that you're taking it at different times of the day and at different prices. So we're doing some of that effectively. So we increased our momentum and added some mean reversion because there's such obvious convexity plays on the short side as well, so we diversified in the same way that an equity long short can typically achieve higher Sharpe ratio than the equity market alone.
Yeah. And if we go back to maybe we could call it normality, because maybe we feel that this current environment is a little bit, unusual. If we go back to normality, would you then have to adjust back to the way you
no,
used to do things?
Our convexity today, expected convexity, is the same that we've had in the last 20 years. Okay. By playing with time frames, right, you can be trading as much mean reversion as momentum and still maintain your convexity, except effectively, it's a play of time frames. So you can be beta neutral, but the sizes of your exposures can be quite different.
And Nigol, you talked a little bit about filtering. Could you maybe clarify a little bit more how you think about that and what you mean by filtering?
Filtering is like the holy grail, if you want. I mean, basically, the alpha comes from filtering. So filtering 15 years ago, trade momentum or trend following only when the vol is compressed. That's one way. That's the way it was. Then maybe 5-10 years ago, it was trade momentum in the direction of the negative skew. And then the skew in option pricing tells you that effectively, if a market starts to go down, there's going to be a trend. There's going to be a very strong drift. If the S&P starts to go down today, the market is expecting that it's going to lose 20% a year. That type of thing. So that's another way of filtering. So the market is telling you that if we go down, we're going to go down a lot. So, okay, we'll go along with you. No questions.
So do you think that you need to spend more time really thinking about that in today's markets as opposed to a few years ago? Is that sort of the secret sauce, I guess one might say?
There's more clarity gained around not the way the markets are, but the way people trade. I don't believe that the markets are a certain way, that if you're long the S&P, you make 7% a year, and if you're long-term, CTAs, you make 10% a year. It depends what people are thinking and the way people are trading, and the way to, on the run, evaluate the level of conviction and risk people are taking. Where is the surprise potential? So vol compression was 15, 20 years ago. Convexity was 5-10 years ago. Today, a lot of what we do is around crowding. Effectively, trade against whatever feels good, do the opposite. And you can do this looking at the relationship between the returns of different sectors, within momentum. You can look at the, certain markets within a sector and assume that things are going to mean revert.
So if it's uncomfortable, that's a good thing.
Correct.
I guess.
If it's uncomfortable, or the way we're programmed to think, how does the way we're comfortable thinking lose money? That's why we bet on that. So today you can hire people out of undergrad who can run optimizations that quadruple PhDs couldn't do 20 years ago. But the techniques available for optimization are pretty much free. As a result, the way people are chasing returns and therefore reinforcing short-term bubbles and then breaking them down, how do the markets depattern themselves, is really critical, is changed. And our job is to basically find ways to provide this convexity with positive alpha at the same time by relying on what people are comfortable doing and trading against it in all time frames. It's available. You can hire 10 quants and they all tell you the same thing, and you do exactly the opposite.
Is there a risk in some ways that, someone shared this with me, and I thought it was interesting. They looked at, if you look at the European part of our industry and you look at the US part of our industry, no doubt, sort of late 90s, I think the Europeans overtook. They were seen, the managers were seen as being more scientific. And therefore a lot of institutional investors preferred that, over the US managers who were more seen as ex-floor traders who systematized their rules and whether it be turtles or someone like that. But it also meant that a lot of the European managers were recruiting from universities to emphasize this scientific approach to investing. But of course, as we know, in the universities, they teach from the same books. Sure. So their approach to, for example, risk management, perhaps are more similar than what we think. And in that, they start looking very similar. I mean, I don't know. It's not a study that I've done, and it's not a right or wrong. But what you're saying is, kind of do a little bit the opposite, be the rebel, and in a sense, if you recruit from the same university and they all end up doing the same thing, maybe that's not down the route yet. Obviously, with a few exceptions, a lot of money is still flowing to those type of strategies.
Sure. So there's two aspects to that trade. First, universities don't teach you what you need to know. They teach you what recruiters want you to know in order to go sell their products. Mm-hmm. So it's not necessarily the best knowledge available. Right. It's you know how it works. Okay, enough of that. Then the next phase is the scientific phase, where are we progressing scientifically in everyday life? Again, investing is not something that can be managed through a scientific process. Absolutely not. It's a complex system where high conviction results in a pattern breaking. So if you hire a scientist that says, people who wear white shirts typically go to the beach and people who wear black shirts are going out, whatever. You can do that in everyday life. It doesn't affect the process. But in investing, the more advanced science you need to do just to understand what people are thinking and feeling, not because it gives you an idea of what the markets are going to do, right? So it's very different. When everybody believes buying the S&P after 2 down days is 100% trade or 90% trade, then the market depatterns. And science is not very good at figuring this out, unless you're looking at the science of the mind, where we're getting there. Another way for us to measure this is the level of conviction that people have in certain trading strategies. Right? So you evaluate the behavior of the returns of different trading strategies. That tells you how the people trading these are feeling based on their Sharpe ratios. And you can do certain things with that. Okay? So first, education is not ideal. It's intentional. Yeah. It's not pure knowledge. Second, there's cyclical, and science will not understand markets. The poor Newton, I think was a good example of that. So you cannot have a purely rational mind when you're trading. You need to realize the cycles of emotions that investors are going through. At a certain stage, that might change. But the frustration today, so people are saying, I want to invest with quant, is because they're frustrated with the macro managers who haven't done anything, because central banks have made it impossible for them. But that's again a cycle where people will run away from quant and go back to the thinkers one day.
Yeah. No, absolutely. As we sort of head into 2018 with all the changes we've seen from different areas and certainly how it's impacted, as we already talked about, the markets and different trading strategies. Well, what are the opportunities? I mean, what are the opportunities that you see? How do you think about that?
It's never been cheaper to hedge. And today, you need to have a very, very disciplined process. Relying on the recent returns as a way to predict the future is going to be very, very, very difficult, very painful, highly risky. So today, I would say investment has to be a process. We need to allocate X% to CTAs. I know they've lost money. I know I don't like them. I know they have no beautiful story. I can tell my investment committee. CTAs are still a very, very valuable part of any portfolio, even with flat returns over 7 years, whatever it is. That needs to be understood, and you need to stick to that discipline. In the market, what's happened since 2009 has been a one-sided thing. The Sharpe ratio on the S&P is something which has been unseen. The S&P is up 15 months in a row. It's unseen. Never happened. These type of things create very extremes in certain type of behavior in the market that CTAs are very, very, very well placed to take advantage of. So I see that central banks are slowly starting to pull liquidity away from the market is the first steps of that reversal, going into a regime where CTAs might make a lot of money for many years in a row, right? That's very important. That's the major factor that I see as the opportunity.
So going the other direction, because you focus on the things that are uncomfortable and sort of the tail risk out there, what are the things that you think are the threats? I mean, what are the things that keep you up at night? The worries, the things that sort of maybe people aren't thinking about that you think are important?
For CTAs.
For CTAs and markets in general, just, given your positioning. And
crowding is much more than people think and much more than people want to admit because they don't want to scare investors. So for us, we're thinking so much in those terms and quite the opposite, telling investors, the markets are really not liquid and this is what we see. And it's obvious, right? So it's almost like you can be manipulating a stock and not tell your investors. You can say, by the way, we're manipulating a stock and we can see it and we're doing it carefully or whatever. So what we see is that CTAs have major impact in the markets, especially short term. We want to be transparent. We want to be honest with ourselves. The more honest we are with ourselves, the more clarity we have in terms of how to deal with it and move forward from there. For me, that's the real danger. 10 years ago, nobody believed in CTAs. Nobody knew how to replicate a CTA. Today, we provide our replicator for free to everyone as a formula. I mean, today, as CTAs start to make money, it's possible that you'll see major inflows. And so you have to catch up, what the liquidity of the market is really there to support that type of trading or not. To me, that's the real driver of performance. You cannot just be a smart beta. You have to, at some stage, say that certain places, convexity is too expensive and you want to actually be shorting it.
I want to add something. I want to add one concern that I have, and that is because of the popularity of the smart beta programs and the flows into that, because they are so similar, there's only very few ways you can do basic trend following or replication or trend following. And I don't think investors really realize the exit risk that they have, in that space. And it's, for me, definitely a concern to see that part of the industry is growing so quickly just because it's cheap. Mm-hmm. So anyway, it's not really about me, but
it's actually worse than that. It means when the market is going to go up, if you look at channel breakout systems, they tend to make, in a lot of real trends, you have, let's say a 20-day high, the market makes a 20-day low and a 20-day high 5 days later. So you have very specific things going on in the market. And in terms of cheap or expensive smart beta, you need to be aware how expensive it is to have the comfort of transparency. Right? So investment committees should know that, by the way, we're aware, it's not a question that, it's transparent and it's cheap. Make sure you realize that the fact that it's transparent and it's cheap is going to be a factor which is going to give us the higher likelihood of negative alpha. Yeah. When investment committees know that,
they'll think twice.
They'll think twice.
Yeah.
I'm not saying it's bad, but it has to be. They have to know.
They
the
have
risk.
to know it. I mean, it's part of the decision. I agree.
I still would allocate to smart beta.
So let's turn it on the other way around. So what's the best question these investors could be asking themselves right now?
Really, again, in today's world, I don't know how investors can evaluate hedge funds or CTAs without looking at multiple levels of convexity, different measurements of convexity. I have no idea how they can do that. It's just there's zero risk otherwise. So to me, that's the most important question. Again, as I said, because it drives the size of the drawdown. How many times your vol are you going to lose depends on your level of convexity. Investors should know that. And also, how to evaluate skill, which is convexity-based versus, alpha, which is convexity-based versus alpha, which is skill-based. Skill-based alpha is stable. Convexity-based alpha is not. So to me, again, convexity, I'm using, it's a simple word, but there's many different ways of doing it. Investors should be desperately looking to understand that factor. Yeah.
So if you had one final thought to leave to investors or...
And you couldn't use the word convexity.
And you can't use the word convexity.
Okay.
What would it be? What would you have?
No, you are allowed to.
Okay, you can use it. I was just kidding. We were just kidding.
I forget, there's a quote. It's, we have met the enemy and it is us. Something like that. In the investment world, that is more true than anywhere else.
Interesting. Nigol, always super interesting and inspiring to have you on the podcast. Let's, on that note, wrap up this fascinating conversation recorded live here in Miami. Nigol, thank you so much for being on the podcast and for sharing your thoughts and experiences with Katy and me. It is so important to have practitioners like you to share these ideas, because when ideas become conversations that lead to action, that's when real change happens. And to all our listeners around the world, let me finish by saying that I hope you got a lot of value from today's conversation and that you enjoyed it as much as Katy and I enjoyed making it for you. And if you did, please share these episodes with your friends and colleagues so that the conversation can continue. From me, Nigol Koulajian and Katy Kaminski, thanks so much for listening. We look forward to being back with you on the next episode of Top Traders Unplugged. And in the meantime, go check out all the amazing free resources that you can find on our website.
Thanks for listening to Top Traders Unplugged. If you feel you learned something of value from today's episode, the best way to stay updated is to go on over to iTunes and subscribe to the show so that you'll be sure to get all the new episodes as they're released. We have some amazing guests lined up for you, and to ensure our show continues to grow, please leave us an honest rating and review in iTunes. It only takes a minute, and it's the best way to show us you love the podcast. We'll see you next time on Top Traders Unplugged.